Well, we're into spring, so what's ahead for our property markets? Today, Dr. Andrew Wilson and I give you our spring property market preview when we discuss the negative and the positive fundamentals for our property markets. Now, if you read the media, you'd believe that it's all negative, but that's not the case, so we'll explain to you what's ahead. But if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. Well, we're well into spring, which traditionally is a great time to buy and sell properties. But what's ahead for our housing markets for the last quarter of 2022? Looking back on the year so far, our housing markets have had a lot to contend with. Coming off a once-in-a-generation property boom in 2021, our markets had to contend with floods, bushfires, geopolitical problems, a federal election. Hey, remember that? That wasn't that long ago. Inflation, rising interest rates, and falling consumer confidence. Now, last year, almost all property markets around Australia saw strong growth in house prices, but this year, the markets, they're more fragmented, which of course is more normal, with the Sydney and Melbourne property prices in particular slowing down, while other markets are still keeping their momentum. So back to my original question, what's ahead for property for the rest of the year? That's what I want to discuss today with Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider Chat. Hi, Andrew.
Yeah, good day, Michael. And happy spring, I guess. Spring has sprung. Thankfully, we'll get a bit more warmth. We'll hope. Southern states have been a bit cold this year and a bit cool in our property markets too. But again, we shouldn't expect anything different because winter traditionally is the distracted time of the year. We have two selling seasons, the autumn selling season and the spring selling season. In between, we do the think music thing, and that's winter. And maybe if we're fortunate enough, we take a holiday to warmer climes during that period. But there are significant school holidays and a lot of bits and pieces. But the whole concept, it's not a concept. The reality of our selling seasons is that people make their decisions around the calendar year. We see the emergence of more buyers and sellers coming through late August and into September. It's because buyers and sellers are thinking about, well, let's get it all over and done with by Christmas. It's a lengthy process to buy and sell, or sell and buy. And that's why the focus then becomes, okay, if we want to do this, let's get it done by the end of the year. Then, of course, we have the autumn selling season, which is people have been on holidays over January, over December, and they start thinking through that period, well, maybe it's time to get that bigger house, Michael. Let's start doing it and let's get it over and done with before the middle of the year. So that's why we have those two seasons. It's really nothing to do with the weather primarily. And of course, that's what's occurring now. We've come through winter. We've come through a tougher winter this year because it's not just seasonal factors that have moderated activity. Of course, we've had affordability raising its ugly head, or maybe not its ugly head, but stabilising our markets after, as you said, very strong period of growth. High house prices have inhibited the capacity of buyers to continue to bid up property. A lot of the pent-up demand that was built through the COVID interruptions has now been satisfied, particularly in the markets which had the most severe lockdowns, which were Sydney and Melbourne. That's been satisfied. That pent-up demand resulted in strong house price growth. So affordability fell predictably in Melbourne and Sydney, and then along came higher interest rates, which was the icing on the cake, of course, for affordability, because it meant you had to be earning more to get the same price or the same loan because your interest rate was higher. But, and of course, the other factor with higher interest rates is the confidence factor, which is very important in the short term. We get the usual blazing headlines of doom and gloom once interest rates start to rise, not really based on any evidence, but anyway, it's a cheap headline and it gets a lot of clicks. So we've had that as well. It's coincided with our winter market. So it's all sort of confounded together, or compounded together and confounded all to create a quieter winter selling season, perhaps, but really not so quiet when we do look at the details. So we're ready to spring into spring, are we not? Typically, and but I guess the question has been, will we have a spring selling season this year, Michael? But interestingly, as you suggested, that we've had a mixed bag in terms of the performance of our capital cities. Really, Melbourne and Sydney led the charge up. They were followed by Adelaide, Brisbane and Canberra, and the other capitals, of course. And Melbourne and Sydney then led the charge down. and they're now being followed by the other capital city markets. But once again, we're seeing that sort of lagging impacts because there are now signs emerging that we will have a spring selling season. To what extent relies on a few factors, of course, where will interest rates go? But I think we are certainly got some evidence that the spring selling season in Melbourne and Sydney in particular is upon us. And the most significant one we can use as a forward indicator, Michael, is certainly auction numbers are on the rise. We will see quite strong auction activity in terms of numbers coming through Sydney and Melbourne over September. We're seeing early evidence of that when we look at our forward indicators. So sellers are certainly happy to be in the market in spring as they are. And that's what we typically see. And the numbers aren't too bad, Michael, which is maybe a bit of a surprise to the doomsayers in terms of sellers being happy to test the market. Now, I guess a lot of what will be said are these desperate sellers, coming into the market, wanting to take advantage of what heat's left in it. I don't think that's the case because usually the desperate seller environment is when we have high unemployment. People are having problems meeting their mortgage. But as we know, we've got a remarkably strong economy now. Everybody's got a job, wages are rising. So I guess forced sales aren't really an economic factor. I'm not sure people, given that markets aren't really showing continued significant stress, that people would be seduced into thinking they have to sell now. And even if they do, well, where are they going to live if they sell? We've got a shakeout in that market. But certainly, Michael, we are seeing a lift in auction listing numbers heading into spring. That is a positive sign from the seller's perspective. It is coming particularly from Melbourne and Sydney, which of course are the spring markets. We know that. Still a little bit of a lag from Brisbane and Canberra, and Adelaide are just holding thereabouts. So I think the first signs are that sellers are happy in Melbourne and Sydney, particularly be engaging the market, which is typically what we see as the early part of the spring market. Now, we've seen buyers probably a little surprisingly active through August, Michael. Clearance rates have held up. In fact, they've risen in Sydney and Melbourne. That's really been a buyer scenario that buyers have been quite happy to engage in that winter market, despite perhaps thinking that maybe prices would be lower going forward. So those clearance rates have hovered in Melbourne and Sydney at or above 60%. We haven't seen the sort of 40% we saw back particularly in 2018 when we had a similar sort of fractious market. And, clearance rates are still strong in Adelaide. They've been consistently strong. But as we mentioned before, Canberra and Brisbane have been the underperformers and have come back to the market over August with lower clearance rates and lower sales numbers.
Well, if you listen to the media, if you read the media, you'd be concerned about the spring selling season because it all seems doom and gloom. And we've mentioned a couple of those factors, but in a moment, I'd like to talk about some of the positive factors. But if we look at the negative factors first, there are a few, and we've mentioned them: affordability, rising interest rates, rising inflation, and decreasing borrowing capacity. But Andrew, what I'm seeing is that the banks are saying decreasing borrowing capacity, and that could drop 10, 15, 20%, considering how high interest rates have moved from virtually zero official rates. Because my borrowing capacity drops doesn't mean that you as a vendor have to drop the value of your price. So I think that's where their logic is wrong. They're saying because of lower borrowing capacity, property values will drop 20%. What it really means in my mind is, as a buyer, if my borrowing capacity is dropped, I may have to move to another suburb, an adjoining suburb, or buy a townhouse or a villa unit or an apartment. As you clearly said, there aren't distressed sellers. And that's one of the positive factors, that the banking system is very resilient and there are very few non-performing loans, Andrew.
Yeah, well, that's right, Michael. And like I said, the big picture is very strong for those in terms of consumer sentiment. And the big picture for consumer sentiment is clearly I've got a job, my wages are rising, my property's still worth 30% more than it was 2 years ago, I've got lots of savings in the bank, and how could things really be better? At the end of the day, yes, my real wages are falling, but I have the capacity to absorb that. And even the Reserve Bank is indicating it doesn't know, and it said that quite clearly, it doesn't know if a fall in real wages will impact the economy. And we have a record fall in real wages at the moment. The point is that it's not impacting consumption. People are still out spending. The offsets are very strong to the point where it's confounding many of the experts that think that this will result in some sort of an ongoing fall in consumer activity.
Well, if you do a checklist of all the things that are positive and all the things that are negative, you'll find there are more positive fundamentals. But consumers, we're emotional. And so at the moment, greed is taking a back seat and fear is really there at the moment. There's the fear of buying early, fear of being involved. And overall consumer sentiment is the lowest it's been for a long, long time. But it seems like with interest rates coming close to their peak, probably peaking early next year, with inflation peaking later this year, once people eventually realise, hey, it's not that bad, I see consumer sentiment getting back and this pent-up demand driving our markets. It may be late spring, it may be early next year.
Well, that's the other point, Michael. If there is this sort of phobia thing happening, fear of being involved, which likely there is, when the fear is addressed as being fear and fear alone, then people will sort of get on with life. And that's the need to think about their dwelling choices and their needs, their accommodation needs. And as we keep saying, Australia's short of housing, terribly short of housing. We're going to have demand coming through offshore from migrants and students, which is only going to add to that shortfall in housing. Building costs, it's not just tough to get through all the green tape and red tape and blue tape that you have to as a developer or a builder. Now you've got to cope with building costs being 25% higher than where they were a year ago. It means supply will continue to lag demand. As I said, if the underlying fear was based on the circumstances of consumers, they got nothing to worry about, really. This is a very strong economy. And look, we've come through a remarkable boom period, Michael, for various reasons we've discussed. And I think that in a way, maybe we'll see the higher interest rate environment and the doom and gloom that it generates being absorbed to some degree by the winter market, which is a distracted market anyway. And maybe that'll mean it'll be pushed behind us a bit quicker. And that once we do start to see things such as higher auction volumes, reasonable clearance rates, sales numbers ticking over, that consumers will realise, well, maybe I've got to start thinking about that old fear of missing out situation and get back into the market after sort of having postponed anything early days, as a result of unfounded fears. Even though it's early days, Michael, we may see July as being the trough of the market, particularly in Sydney and Melbourne. If we look at asking prices, and that's another forward indicator, the decline in asking prices, which is certainly there in July, down by around 2.5% in Sydney and 2% in Melbourne. The decline, even though prices are still lower, look to be less over August than over July. So the trend is now starting to look like prices are bottoming out, that we're seeing the turn of the market from price declines. And we would expect that in winter anyway, Michael. And obviously, as we've said, exacerbated by those affordability issues. But maybe we've just seen that prices will start to bottom out, or are bottoming out now. And obviously with the regeneration through spring, that will put upward pressure on prices.
Another good forward indicator is finance approvals. And while they're slowing down a little bit, last month there was still over $30 billion worth of finance approvals. Somebody's going to be buying, or a lot of people are going to be buying $30 billion worth of properties in the next little while, Andrew.
That's right, Michael. But I think the big picture is that we're certainly seeing what we would consider to be the normal increase in buyer and seller activity coming into September. And that's what we see every year by and large, particularly in Melbourne and Sydney, which are the big spring market. I think that if there's any lag in other spring markets such as Adelaide and Canberra, it'll be because they've had such strong growth more recently than the Melbourne and Sydney market, which is sort of looks like it's now heading into a recovery phase through spring, which is the seasonal impact anyway.
Well, the permanent property pessimists are still out there telling us how much debt Australians have taken on. But if you look at the Australian Bureau of Statistics figures, there's about $10 trillion worth of total value of residential real estate. And overall, all the debt against that is $2 trillion. Our housing markets are in pretty good shape, considering that half of homeowners don't even have a mortgage.
That's right.
A lot of homeowners who've got a mortgage are still having fixed rate mortgages. A lot of those who have got variable and fixed rate mortgages are still ahead in their payments. And household wealth it's actually still pretty good, our balance sheets. I know we're paying more for cabbage and cauliflower and broccoli. I'm not even talking about the lettuce that people can't afford anymore. But overall, household wealth is pretty strong, Andrew.
Yes, Mike. I think we're sort of moving past that terrible furphy of Australia's debt levels and what that was going to mean. That's been a tired old story for, a decade now, and it's had absolutely no sort of outcome that was predicted. There are a number of different variables to debt, how you measure it, and of course the offsets that assets have. There's always that measurement of incomes to house prices. But how could possibly house prices continue to rise when incomes weren't keeping up with house price growth? And that was another so-called predictor of house price crashes. But of course, those that were predicting it in those simplistic terms forgot about falling interest rates and the impact that has on positive affordability. And we don't even hear about that anymore. Again, I think the debt scenario, even the Reserve Bank stopped commenting on debt, knowing that it has no impact on the real economy, particularly in the short term, and certainly no impact, aggregated national debt, on housing markets.
Well, over the weekend, I saw a headline in one of the national TV stations saying every suburb in Sydney is in mortgage stress. Really? Now, what they did was they took what it would cost for the average mortgage in the suburb and said it was more than 30% of the gross income for that suburb. But boy, is that a very wrong generalisation in my mind.
These stories, I would have thought even the media were getting a little tired of how wrong these, whatever the measurement process is, and where are the outcomes? Whatever happened to the debt bomb, Michael? The famous debt bomb. Well, I think the only debt bomb was the one that blew up in the faces of those that have been predicting it, and it's blown up, but it still gets legs, but it's just nonsense.
So, on balance, this year is going to finish off a bit weaker than 2021, but I know that earlier this year you made a couple of predictions that Melbourne and Sydney's markets are going to end up lower than they started, but the other states are going to end up a bit higher. So what are your thoughts? How's our property markets going to finish at the end of the year?
I think the prospects are certainly brightening, Michael, that confidence is returning, particularly to the Melbourne and Sydney markets, that, the undersupply of dwellings, again, is an essential force. But I think the clear generation of increased activity over spring is it's a strong economy we've got, Michael, which is just only going to get stronger, really, I think. And people have got all these positives in terms of their personal balance sheets. They're not going to be putting off the big decision of buying or selling a house. And it only perhaps makes them feel that they're in a position to take advantage of a weaker market and perhaps less competition for buyers out there. So most sellers are buyers and buyers are sellers. So they take advantage of being in that market. And at the end of the day, Michael, interest rates are still well below historical averages. The only catch is wages growth. But, the Reserve Bank's predicting wages growth to pick up quite strongly going forward. So I suppose there are many that are hoping that prediction comes right. But I think even notwithstanding that, I think that we're certainly seeing the onset of the spring selling season as usual. The question is just what sort of momentum that will deliver through the 3 months until the end of the year.
It'll also be interesting to see what's going to happen to that backlog in processing visa applications, because there's a desperate cry for immigration, and that people are starting to come in, skilled migrants, backpackers, students to a degree. Interestingly, when you look at the latest migration figures, there's also been a lot of Australians finally leaving the country now that they are able to do that. But all these new people coming in from overseas are not bringing a house with them. So that's going to put extra pressure on the very strong rental markets. So I can see rents only increasing over the next year.
Yeah, that's right, Michael. So as I said, it just validates the fact that we have a shortage of housing, and those that are fortunate enough to be established in the housing market are in a position where they can continue to search for whatever they feel is their next journey in property. And the other point to higher rents is a strong economy is people with their wealth generation are continuing to be drawn to residential investment, validated by high rent returns. Where do you put your money? Well, millions of Australians are small-scale residential investors, and we've seen a surge in investors over the last year. As I said, I think that investors are still part of the spring equation, particularly given prices are lower and yields are higher.
Well, it'll be interesting because the governments are giving many investors a hard time. They've pulled the rug out from the foreign investors, and the Queensland government is going to increased land tax for anyone who owns properties, not just in Queensland, but other states. And most of the states are changing their residential tenancy laws, making them more in favour of the tenant. So again, we see headlines of people getting out of property investment because it's just all getting too hard. That's only going to tighten the rental markets even more.
Yeah, I'm just thinking how they can, what policies the Queensland government can have to stop Brisbane house rents reaching $600 a week median, which is just about to occur, Michael, which is a lot higher than where they were just 2 years ago.
Beware of unintended consequences. So we've got a spring season coming on. We'll be getting back together each week to talk about it. But I think spring has sprung, the grass is riz. I wonder where the birdies is. That sort of comes to mind from when I was a little kid. I think the birdies will be out there too, and they'll be watching the auctions occurring.
Yeah, well, signs are certainly early signs, but the signs are there quite clearly that the market is going to rise into spring, and it's all a question of what sort of momentum that can generate.
Look forward to catching up with you again next week, Andrew.
Yeah, thanks, Mike.